All right, good morning. Today is Thursday, February 20th, 2025. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as our different social media pages. If you are here with us live today, or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, Chief Investment Officer Tom Fox, who we will hear from in just a couple of minutes, financial advisors Dan Oshman and Rana Grant, and our client support team, Josh Denny, John Knutson, and Marilyn Westmark. Together, our goal is to help individual investors make their next financial decision and the one after that a good one. Today, we're going to hear from Tom Fox. Tom will review the positives in the markets. He will go over the headwinds, and he's going to give us his outlook for the rest of this year. Ultimately, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets, in the economy, and what we are watching for. So I encourage you, if you have any questions whatsoever, put them in the chat box. So no matter what platform you're watching from here today, go ahead and put a question in the chat box. I will see those and I will bring those to Tom at the end of his message. You are also more than welcome to email me directly. I do have my email open. I can receive those during the call here. And of course, if you're watching in the recording, you're invited to email us as well. And we would love the opportunity to circle back with you again with any question whatsoever. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, really focusing his attention on the economy and the markets. He has over 35 years experience building investment strategies. He has an impressive long resume. And as always, I'm very excited to have him part of the team and delivering his message here during this monthly update. And again, I can't stress this enough. At the end of today's message, we will have Q&A. So if you're watching, please post your questions, big question, small question, whatever question you may have. We would love the opportunity to field anything. With that, I'm going to bring our theme for 2025 up onto the screen and bring Tom onto the stage. Tom, good morning. Welcome. Thank you for being here today.
Well, good morning, Eric, and good morning, everybody. Excited to be here.
Yeah, on this cold Minnesota day. So for those of you here with us in Minnesota, we hope you're staying warm. It's been just a brutal week, but I think we've got some warmer temps here coming. So that's
good. I think it's over, Eric.
I hope you're right, Tom.
For the rest of the year.
Yeah. So our theme continues for 2025. The times they are a-changing. The floor is yours, Tom.
All right. Well, thank you, Eric. And of course, that was our theme last year, but it didn't quite unfold like we thought it would. So we extended our theme, the times they are changing. And we think there'll be change. Of course, with the new administration, many things are changing, and they're changing very rapidly. So we'll talk more about that. So let's get into the outlook for 2025. And I always like starting off with the wall of worry or uncertainties that are out there. And there's plenty that we have listed here. One is valuation of the stock market and how highly valuated it is. Now, historically, we looked at this last month when we presented at the club, that when you have this kind of a high valuation, the forward returns in stocks can be muted. And of course, we had two back-to-back 20-plus year stock market returns in 23 and 24 for the S&P 500. And when you have that, it's a low probability that you'll have another strong year in the third year. And that's where we are today. And of course, valuations, when they're this high, and we're looking at a 22 plus forward-looking earnings. So this is going to probably mute the forward returns as we go throughout this year. Now, we also are worried about, these are the things we worry about, is slowing economic momentum. And we think we're starting to see a little bit, not big, but just beginning to see little traces of things starting to slow down, especially with the recent retail sales. We'll look at a chart on that later on in the presentation. But retail sales dropped significantly more than what the economists were expecting. And next month's retail sales and the following months are going to be critical. Are we into a one-time off, disappointment in retail sales, or is the consumer beginning to pull back? And remember, the consumer spending is 70% approximately of the GDP of our economic growth. So it's if the consumer begins to pull it back, that's going to have a kind of a domino effect. So that's something we're watching for. And then we have liquidity and credit market stress. We've noticed that there's been a decline in the money supply as growth. And if money supply is how much money is circulating throughout the US. And if there's a lot of money circulating, that means prosperity. But it's been falling. And if it falls below 5%, that's not a good number that we're looking at. In fact, during the pandemic, it went over 20% because the government flooded the market with circulation of money. So we're going to watch that very closely, because if it drops too far, it could be the opposite of prosperity. And also we're starting to see high yield markets, and there could be an increase in risk of defaults, especially if the economy or the consumer begins to pull back. And we'll look at a chart on that. It's okay right now, but it's something that we're watching very closely. And of course, we have, with the administration, we have policy uncertainty, a lot of volatility. We have tariffs, or maybe no tariffs, or maybe negotiation. But I think the market initially, when the president began to talk about tariffs, expected him to do it. And of course, they got delayed with Mexico and Canada. And he's threatening more tariffs to equalize what's going on. They're charging tariffs on us, so he wants to bring it to a normal. I think many nations have been taking advantage of the United States, and that's his goal, is to fix that. However, it's hard to say whether or not there's meat on the bone, or it's just hearsay, or what he's just kind of negotiation. He's the art of the deal. So we'll see what happens. But the market has had volatility because of that. So we're watching that, and that we don't know where that's going to go. And of course, you have the Ukraine. We'll look at that situation. Russia just down here in a few seconds. So we have earnings risks. AI and tech have driven growth stocks as well as other companies. But there's a high expectation for earnings, and it's double-digit growth is what we're looking at, what the market's looking at. However, if the consumer begins to pull back, that's not going to be achievable, and that means they would have to rewrite all their earnings forecasts, which would put a downward momentum on the stock market. So when you have double-digit expectation, there's not a lot of room for errors or things not meeting expectation. And of course, we have the geopolitical risks with China. We have Russia and Ukraine. And that's going to be interesting how this unfolds. J.D. Vance, the vice president, was talking about that we may get involved with military if Russia doesn't, come to the table and begin to negotiate properly. So that could go well, or it could go down fast. We'll have to see how that unfolds. But you got Israel, Hamas, Iran. You have plenty of geopolitical potential. Something could go wrong, which if it goes wrong in a big way, it could impact supply chains, energy costs, and many other things. And then you have the market sentiment and speculation. We kind of have a two-edged sword here. We'll look at a chart where retail investors are very bearish in their next 6 months outlook. But however, what they're doing is they're buying crypto, AI, meme stocks, and other things which is can be pointing to speculative excess. So we'll have to see how that turns out, but that could be a warning sign that we're getting near the top of a market. But we'll look at where the retail investor is on the next 6 months. And it could actually be a bullish sign when they're very bearish. We'll look at that in the coming up here in a few minutes. So we always have a list here, and I've expanded this list, why we should own stocks. It's kind of a barbell, why we shouldn't own stocks, what are the worries, and then on the other side, why we should own stocks. And one is the resilience of the economic growth. The economy, GDP growth has been doing very well, starting to slow down a little bit, but it's still very, very strong. So we haven't seen the economy roll over yet, and it's been very resilient. And a lot of that has to do with the consumer, which we've been talking about. And then corporate earnings growth. On one side, maybe they're a little too optimistic. On the other side, they expect companies to continue to do well. Typically, there's a direct correlation between stock prices and earnings. So we'll see, but so far, so good. And the fourth quarter, we're just getting out of. We'll look at a chart on this. Stocks did very well ending 2024, and they had great numbers. So as of the end of the year, companies have been doing very well. So, and the corporate balance sheets are generally healthy. You have to go sector by sector, but they're generally healthy. Many companies continue to generate strong cash flow, dividends, and such. And so the companies are looking pretty good right now. And there's contained inflation. Now it's been kind of bumping up a little bit, but as Fed Chair Powell said, he doesn't look at one or two numbers. They got to see a longer term of consistency or some pattern that develops over time. So it's come down significantly, the inflation rate. Of course, we like to see it come down more. And we're going to look at some charts on what caused the inflation to bump up a little bit. And we think it's unsustainable that the numbers will stay this high. And I think they're going to roll over and we'll look more. And that's good for stocks. If inflation starts coming down, bonds do well and stocks tend to do well also because the Fed may have room to lower rates. And then we have room for monetary policy. They can cut rates, and that's what we expect, at least one more. And if the economy begins to weaken or employment begins to weaken, we're expecting the Fed to lower rates. Right now, you remember it was quite a number of expected cuts by the economists, but now they've all pulled back and said no cuts anymore this year, and some are saying one, a few are saying two. So we'll have to see how that unfolds, but there's plenty of room for them to lower rates. We're not at 1 or 0. They can go quite a distance if they need to. Market leadership is broadening. That is a good sign. When we get just away from the mega cap tech stocks, and now we're starting to see a little broadening in some other companies starting to do well. And if that happens, that normally, at least historically, is good for stocks when you start to see more stocks participate versus a handful of mega cap tech stocks. Structural tailwinds like artificial intelligence, clean energy infrastructure, and future growth, creating opportunities for long-term gains as well. So there's structural tailwinds that are good, that are coming. We'll see what this administration does with all that, but we still think it's a positive. And then, of course, the global market recovery. We're starting to see Europe rebound after a long period of underperformance. Europe is starting to turn around, and that's good for the whole of global markets. So that's another positive as we move forward. So I'm going to show you, we're going to look at some positives for the economy and stocks and just a few charts. Some of this is what we just talked about, but it's always good to look at it graphically. And this particular chart shows manufacturing. You can see there's a gold line going horizontally, and that gold line represents the number 50. And when it's above 50, it means that the economy is expanding in the manufacturing sector. If it's below 50, it's contracting. And you can see it's been contracting for quite a long time. But just recently, the manufacturing numbers went over 50, which means expanding. That's a good sign that perhaps the economy, and at least in the manufacturing area, are starting to turn around. So that's a very positive sign for economic growth going forward. This chart is showing the CPI inflation year over year versus wage inflation or wages growth. And it's always good when inflation's not outpacing wages. And you can see it turned around in the middle of 23, and it's been outperforming CPI, which is a good sign. That means my wage or my income is growing a little faster than inflation, which allows me to continue to spend money and contribute to consumption in the future. So this number is very positive, but it's a good number to have that little extension there above inflation, and hopefully it stays that way. We've been talking about corporate earnings, and as I said, the fourth quarter is coming. There's still some companies left to report, but so far so good. 78%. That's a high number of companies beat their estimates, and they did it not by a small amount, 7.2%. So the fourth quarter was gangbusters for companies. Plus the revenue, 61% beat expectation, analyst expectation. Not as wide, but a 0.9%. But these are decent numbers. This shows that corporate America is still in pretty good shape. And again, of course, that's because of the resilient consumer has been out spending, spend. Another positive is that the earnings for other companies outside the Magnificent Seven are beginning to show signs of growing. We've talked about that, but it's just not, we've had historic earnings growth from the mega caps tech earnings and the Magnificent Seven companies. They've just blown it away, 35%, 34%, and 24%. But look at it. Now that's going to come down. But the good news is that companies outside the Mag 7 are expected to rise. And that's good news. Now we're still going to get decent year over year estimates from the Mag 7. However, the other companies are starting to rise up, and that's typically good and healthy for a bull market to continue. Now, this is a contrarian indicator. Recently, the AAII sentiment, which is a survey of the sentiment of retail investors, and that has been getting more and more bearish. You can see that now the last reading was 47.3% were bearish, and only 28.4% were bullish. So that's a minus 18.9. That's a very bearish indicator. Now you may think, okay, well, if the retail investor is not going to go in, and they've been investing heavily, that means that the stock market may be at a point of going down. But if you look at the historical numbers, this is showing when the worst reading, which we have, is that minus on the far right. Eric, if you could advance that.
Where are we looking?
Next chart.
Oh, next chart. Sorry.
This shows that minus 18.9, which we just looked at, is the gap here. We haven't been this bearish since November of 23. But if you go to the next chart, you'll see that ranks around the 10th decile. And what it shows is that the more bearish the retail outlook is for the next 6 months, the better the stock market will do in the next 6 to 12 months. And you can see that the blue lines, the blue for 6 months and 12 months, you can see as you get farther or more bearish, the numbers going forward are better and better. It's a contrarian indicator saying that, hey, if you're in the 10th decile, that normally, historically, has been good for stocks because the retail investor, unfortunately, is typically on the wrong side of it. So this is actually a bullish indicator today because of the bearishness of retail investors. Now, that's what we call a contrarian indicator. Now, does it work all the time? No. We'll have to see how this unfolds, and especially if the consumer begins to pull back, that could throw something into the gears. All right, we'll go to the next one. This is credit markets, and this is the spreads between high quality and low quality. And you can see on the far right, 24, if you go to the far right numbers, you can see how low they are. You can see where it peaks up. That means that risk was coming into the market. But today, all the credit spreads were pretty good signals showing stability, even amid the inflation concerns we've had. So there is no indication looking at credit spreads, because normally what will happen if people begin to sense that we're going to go into some turbulent times, they'll begin to move away from the riskier credit and go into the safer credit like treasuries. But we have not seen that yet. But this could move quickly. But right now, it's looking very good and bullish for stocks. All right, inflation still stinging consumers. We're going to look at a chart. Why does it feel, even though inflation has come down? On the left side of the chart, you can see the peak that occurred back in 22. And then you can see how much inflation has come down. But why is it the consumer still feeling the strain? Well, in the right chart, it's the cumulative component of inflation. And if you look, the spread between what would have happened if we would have stayed at a 2% inflation rate versus the high inflation that we see in the left that we had, you can see that the prices of things have gone up on average about 16%. And now some things have gone up even more, but about 16% on average. I'm paying 16% more, and that has not gone back down because it's a cumulative effect, even though our current inflation has been coming down. So this is why the consumer is still feeling the pain, because that number on a cumulative basis is still rising. And of course, everything is still more expensive. Now, I want to look under the hood of the recent inflation number that we got, core CPI, and remember, it was a little hotter than expected. So people were concerned about that. But when you look into the details, you'll see that the month-over-month contribution to that number was primarily from 5 components. And all of them, most of them relate to cars or trucks. And you can see that the used car and trucks was up, contributed 0.07. It was up 2.19%. We saw leased cars and trucks rise pretty amazingly, 7.41, but contributed 0.74. And then we had the auto insurance, that was up 1.99, and that added 0.07. And then the shelter, which was up 0.17, that's a big component, that added 0.37. And then, of course, the motor vehicle fees. All 5 of these, we believe, are unsustainable to continue to have this kind of a jump in the monthly inflation numbers. So what does that mean? That means that just 5 components, the rest of them are doing quite well regarding inflation. And so we just need these 5 to level off. And we think they will, because we don't think they can continue to go up at this rate. So we expect inflation probably is going to roll over again, which would be very positive for bonds, be very positive even for stocks and some, especially some stock groups. So looking under the hood, we think the next couple inflation numbers may roll over again. And of course, you can see that the Fed has currently on hold, and a lot of this has to do with economic resilience. And you can see that the core PCE inflation, which is the preferred Fed measure of inflation, you have CPI, then you have the PCE, and then you have the target, which is the Fed, where they want to get to is 2%. You can see that there's been a slight uptick in the PCE, kind of going sideways, but the Fed wants that down to 2%. So the odds of them lowering rates until that starts to show a pattern of heading towards 2% are pretty low. And of course, on the other side, their dual mandate is employment and prices stability. So they want to keep price stability, prices going down, and maybe just growing at 2%. And of course, they want unemployment to be strong. So they kind of have that dual mandate. So if the consumer begins to pull back and if the unemployment begins to rise, that could be another reason for them to lower rates, or inflation starts beginning to head towards 2%. So either of those two could impact whether or not the Fed will lower rates in the future. So we'll have to see how it shakes out. We think they will lower rates again this year. We're looking at one cut unless something unfolds in the inflation and the employment numbers. So we're watching that very closely. Of course, if that does happen, we're going to see bonds begin to rally, which we expect at some point this year. All right, potential signs of cracks. Well, this is the one we talked about. This is a big one. Was this an anomaly? Did it just happen last month? We saw that retail sales dropped more than 0.8%, and that was significantly lower than expectation. So what is going on with retail sales? Are things happening? Is the consumer beginning to pull back? And of course, the next two numbers and over the next 2 months are going to be pretty critical if there's a continuation of this or was a one-off. And this will be a big determinant of how things begin to go forward. And so this is a very big number, but it was a surprise to the downside. And we're going to see, remember, 70% of the GDP, our economy growth, is the consumer. So we'll have to see what they do over the next 2 months. All right. Now that we've talked about how optimistic the analysts are for corporate earnings, and of course the fourth quarter delivered, the question is, can it deliver the kind of numbers we're looking forward? Any disappointment, anything that comes in less than expectation puts the markets in a vulnerable place and could cause stocks to turn around and go down. So we're going to have to see how this unfolds. And of course, a lot of it has to do, again, with the consumer, but there is a lot of risk having double-digit expectation. Here's another one. We talked about valuation. You can see that this is the equity risk premium. Is there any advantage of priced in to own stocks with the kind of volatility you get with stocks? What it shows is there's no advantage today with the volatility you get in stocks to own stocks over bonds when you get to that zero line. So that's why we have that position in bonds, because we don't see an advantage to stocks looking at the equity risk premium. You can see it's now down to pretty much saying no advantage. So we're going to see how this unfolds, but we're expecting a rally in bonds at some point. And of course, if we see a rally in bonds relative to stocks, then we will make some movement and reallocate towards stocks for the next leg up. Of course, in this, there's another risk that's out there. We've talked about this, is the tariffs. And you can see the effective tariff rate, which is the orange line going across time. It's been fairly low, under 5%. But if Trump puts on a 10% blanket or 10% blanket at 25 on Canada, Mexico, you can see how high it would go. It'd be like back in the 30s and 40s. Now, it hasn't happened. A lot of this is negotiation, but this does cause market volatility. So we think there'll be continuation of market volatility as we move forward, because of we don't know what's negotiation and what is, meat on the bone for tariffs, but we'll have to see how it unfolds. Here's some potential opportunities we're looking at. If you look, this is AI, a key driver of supply power, and utilities are going to benefit. Some utilities will benefit from the need of power for all the AI modeling and data centers. So there's going to need to be a build out, and it could be a beneficiary to some utilities that will have that advantage in that category. And this is showing the returns of the group AI related utilities. You can see they've been done very well relative to the S&P 500. We, in fact, in our sector, tactical sector, we do own utilities, which has done very well. But we're going to be looking for companies that have advantages to deliver AI power. Now, that it doesn't happen overnight. It's more of a long-term investment because they have to build things out and supply that power. But you can see that the market's already discounting the future. So this is an area of opportunity that we are now looking at. And another area which we have not gone into is Euro area equities finally turning a corner. You can see if it's above the zero line, those blue bars, that means that the international stocks are outperforming. And if the bar is going down below zero, that means international stocks are underperforming. And it's been a long time, because under the international stocks, which we have avoided. Now, most financial planners, most investment advisors always have a certain percentage towards global or international stocks. We have not. We have been U.S. centric. And that has been a very good decision because of the underperformance of Europe and other international stocks, including emerging markets. So we have avoided it. Now, will we begin to add something? We're evaluating that today. We think it's still too early. We think this could be just a kind of a bump, but we're going to look at the United States exceptionalism in a few charts. We still think U.S. is where you want to have your money as going forward. And we got a lot of things going on with this administration to lower restrictions for companies to do even better. And even AI, we're leaders in the AI, and we'll see how this unfolds. Another area that's interesting is the commercial office. We've talked about this for over a year. About the risk that's in commercial office real estate. And you can see what's turned around here is the U.S. net absorption. That means that the vacancy rates in total have begun to stabilize. And you can see it actually went up. But you can see the blue, how much the vacancy has gone up. But recently, it hit a little up mark. And so this could be a turning point in office commercial sector. So we're looking at REITs that may benefit from that. But these are some of the areas that we're delving into, see if we can implement those into the portfolio. All right, American exceptionalism is intact. This is the U.S. innovation continues to rise. This is an innovation index. You can see that it's really moving up, and we think innovation in the United States far superior to anywhere else. and we believe it's going to continue. This is all very good for investing in the United States of America and investing in U.S. stocks. So we think going forward, we want to stay in America primarily, but we are looking again at the international stock market as well. If you go to the next chart, I get calls, probably, Eric, you probably get these. I get about 2 a year, maybe 3, where it goes around, it's the end of the US dollar's dominance and that other dollars are going to take over. Well, this is a chart showing the demise of the US dollar is dead wrong. And I think it's more, I don't know, conspiracy theories or whatever goes around, but the US dollar is doing quite well. It's almost 50% of all the currency exchange. And you can see the next one is the euro. If you're worried about the Chinese yuan, well, you can see that's the little green mark, dark green mark, and it's hardly anything in terms of its use. So that the US dollar remains the go-to for currency. And if you think otherwise, or you read some conspiracy theory, take a look at this chart. It just doesn't, go with that idea. It's the dominant currency. That's good for US. Here's the GDP expansion, but this is the world market cap of all the stocks in the US and trading. Where is the most of the stocks being traded? Well, you can see that 50%, just like the currency is 50%, the US market cap as a percentage of the world market cap, we're running about 50%. And look at the trend. It has been going higher and higher and higher throughout the years. So the US companies, United States stock market is still the go-to for growth and dominance relative to the world. And another area that's US is doing quite well at, and that is the producing oil. And you can see, is it Saudi Arabia? Is it Russia? Is it Canada? No, you can see the United States has become the dominant oil producer. And of course, if you remember, our president said, drill, baby, drill. So this is probably going to even go higher. So we're dominating so many different areas of the world, and we don't expect that to change anytime soon, which bottom line means this: the US stock market is the best place to invest. It may be it's the cleanest of all the dirty shirts throughout the world. All right, AI expected growth. I put this in here, and impact on jobs and wages. Maybe you've got a grandson or a son or children or men or women who are going to look for a job. Well, you don't want to go into certain areas. If you're going to go into an area, you may get a job replacement with artificial intelligence. Here are the 4 areas of where AI will have the top use cases. And one is job automation. Second is accelerating scientific discovery. We're going to see so many things discovered in the next 5-10 years. And AI augmented creativity and productivity. We're going to see that with corporations, eliminating language barriers and global communication. I don't know if that's a good thing or a bad thing, Eric. I keep thinking about the Tower of Babel when they were all speaking the same thing. When all the people could communicate, it wasn't good. But we'll see how that shakes out. But that's one of them. If you go to the next one, this is all reminiscent of the wireless growth. And if you look at this chart, it's the parabolic growth from 50 million to 9 billion of wireless cell phones globally. And AI has the potential to match that kind of growth, parabolic, or even exceed it. And you can see, I get to travel to a lot of emerging countries. And let's say I'm in a country in Africa because I do missions. And if they don't have landlines, they have all cell towers. And when you leave the airport, it's all advertising about cell phones. I remember being way out in India, way out in the bush, and it could have been, you wouldn't have noticed a difference if it was 2,000 years ago. But there was a guy there, the agricultural area, ox pulled cart. It was like going back in time, but there was the guy riding the ox pulled cart, and he had a cell phone. So it was pretty amazing. It was like I was 2,000 years ago, but it was actually, there was the modern contemporary cell phone. But this is where AI could go. And here is a list put together by Fundstrat scientific team, but it lists a lot of jobs that could be replaced, and it could replace about 5 trillion in wages by 2030. So if you're gonna, somebody looking for a career, these are probably not the list of careers you want to head towards. But that is, Eric can send that out if you want that. But I thought it would be interesting to look at that. This is where it's changing. All right, here's our conclude with our updated outlook. And there hasn't been much change, very little. We're still holding from last month. We put this together very similar to our last month when we presented it at the club. The economy cools, we expect it to slow down. And now we're starting to see that retail sales. We'll see where that ends up going. But it is still supported by other things like technology and infrastructure. But we do think at some point this year, recession talks may reemerge at some point. But again, the consumer, my last 2 words there, consumer is key. We expect stock market volatility to increase, but we expect stocks to trade in a range most of the year. Then there's underperforming sectors outperforming, and we're already starting to see that. We're starting to see that breadth of stock market performance beginning to broaden out. And actually right now today, if you look at the Magnificent Seven or technology, it's underperforming the S&P 500. So we've already started to see this begin to unfold as we've forecasted. That's already started. Healthcare is doing well. Utilities are doing well. Tech's still okay. Energy is doing really well, but tech now is underperforming year to date. It's only up 1 or 2% versus the market, which is up twice that. So inflation restarts downtrend. We didn't see that in the last one, but we do believe that's going to begin to happen it's going to start heading back to the 2% goal, and that the Fed restarts rate cuts. Federal Reserve reinitiate rate cuts because of that, but maybe employment starts to deteriorate, and or the consumer begins to pull back. The jobs start getting cut. Those are all reasons that potentially could happen. Bonds rally, bond prices rise during this, if this unfolds, and as a response to lower interest rates, and maybe more stock volatility to the downside. So we expect stocks to experience a correction. Remember, we haven't had it for 2 years, so we expect that a 10% decline or more will happen at some point. We don't know exactly what the catalyst will be, but the probabilities are there that we will expect a 10% plus pullback from the peak in the stock market. But at the end of the year, at the end of the day, we expect a 0 to 10% return. We haven't changed that outlook. Somewhere in there, we're not expecting, again, the probability is very low for double-digit returns, even 20+% like we've had the last 2 years. We don't think that can happen. We would be shocked if it does, just based on probabilities. So we think it's going to be a range. The stock market will be in a range with a correction at some point and then recovery, but end up somewhere between that 0 and 10% return for the year. And of course, the wild card that could influence all this is the geopolitical or assassination. Trump's had 2 of them tried on him. We'll see But if any of this unfolds, or let's say that the Ukraine-Russia negotiations that are starting now begin to go not go in the right direction, that could cause some volatility and some downside. So all these are out there. We don't see a bear market coming at this point. We only would see a pullback and then a recovery of that pullback as we move forward through 2025.
Wonderful. As always, Tom, really appreciate your objective look at all the different areas of the economy and the markets. With that, I'll open up to any questions. So if any of you, I see a few of you out there watching here live, thank you. Open up to any questions. You can put it in the comments section. You can shoot me an email. Also have my phone here if you want to shoot me a text. And that works as well. While you are contemplating posting those questions, I will just remind everybody that I will have, well, number one, the recording of this will be on the website here right away after we're done. I'll also post a summary of the presentation. So if you want the Cliff Notes, 2-page summary, headwinds, positives, and an outlook. Also an opportunity to ask a question on the website. If you'd rather keep your question more private, you can use that button. It'll come right to me. Tom and I will discuss and circle back with you at our very first opportunity. Looking ahead, our next monthly update, you can mark your calendar, is scheduled for Thursday, March 20th. We'll do it online again, just like we are today. So you can look for that on the website. If you put in your email there, you'll get a nice reminder the day before and the day of that presentation. I don't see any questions coming in just yet, Tom. Give another minute here. Of course, many of you know I do start my week off Monday mornings, 9 a.m. Central, with a very brief update on what's going on in the markets. 3 to 5 minutes tops, kind of summarize what happened in the previous week, what we're watching for the week ahead. Again, broadcast that on the website, LinkedIn, Facebook, all the different social media pages as well. And then 2 o'clock in the afternoon, I send out an email with even more than what I talk about on Monday mornings. So if you're not getting that email, you can head on over to the website and subscribe. Love to get you on that list. I don't blast your email box with a lot of emails. Try to keep it to that one on Mondays at 2 p.m. Central. Tom, I don't see any questions coming in. Any final thoughts you'd like to add here?
No, just remind everybody that we do keep our finger on the markets and the pulse of the market, where things are going. And we're working very hard here to make sure their investments are doing what they're supposed to do. And so it's a privilege to do that. I love doing that. I know Eric loves doing it, but just very thankful for all those who entrust their future with Eric. And so very happy about that.
Not just me, but the whole team. And I
The whole
couldn't have said
team.
it better myself, Tom.
That's right.
It is a privilege, and we thank all of you for the trust that you put in us sincerely. So with that, I think I'll close up the call here, Tom. So again, thank you so much. Appreciate you. For
Thank
those
you,
of
Eric.
you watching in the recording, do not hesitate if you have any questions. Reach out to us directly. We would love to field any questions that you have. With that, that concludes our monthly update for February here, and we will look for you all in March. So have a wonderful rest of your day. We'll talk to you guys all very soon. Bye, everybody.